All right. This morning, we're going to talk about inflation in the US and how I'm looking at it right now. And we're going to ask the question, is inflation going to continue to fall? Now, it's important to understand that CPI is technically not inflation, it's an average of prices. Whereas when we talk about inflation, we're usually talking about the inflation of the money supply, which has definitely happened in the US. Let's get into the current CPI numbers. I've prepared a chart to look at that right here. And what we can see is that US CPI in the month of June was down to 3% after a huge spike. One of the lessons I've learned as an analyst is that whenever you have a spike, you always have a fall. Whenever you have a fall, you always have a recovery. Now we can see the long-term average of this period from 2005 to the present period is about 3% and, 2.5%. That's the blue line. And the red line here is showing that it's down to 3%. And the question is, where is that going? Is it going to fall from here? So I've prepared a series of charts to try to go through that. I just want to mention, if you have any questions as I go through, feel free to ask in the chat, and I'll do my best to try to answer them. So let's look at the next chart. I've brought the food component into this chart, and food is 14% of US CPI. So it's not a huge component, but it did get impacted pretty hard. The food supply chain got hit hard during the COVID period. But we can see that actually the food is really racing down. It's coming down at a very fast pace. And that is part of what's driving that US CPI down. So let's continue and see what's happening with energy. Now, energy is a little bit tricky because energy is only 7% of US CPI. It's a small amount. But man, when energy moves up or down, CPI moves because energy basically affects everything. So we are in a pretty serious collapse in energy prices coming off of the peak during the COVID government-induced boom, basically, that we had. And I would say that if oil continues to fall in price year on year, what we'll see is that oil will keep CPI down. Now, there is going to get to a point here in the next few months where the oil price is going to have a year-on-year comparison that's going to make it hard for it to fall so much. And so what I would argue at this point is that as long as the oil price stays down, US inflation is going to be down, or US CPI. If we get a bounce in oil, we're going to get a bounce in inflation. So far, we don't see a bounce yet, but I would say that we could see one. Now, one of the reasons why we're not seeing a bounce is because of the fears of recession. And basically, what you see in that case, if people are anticipating a recession, they're slowing down spending, and they're also basically their expectation of economic growth and therefore demand for oil is going down. And the result of that is that oil price can't get up. And that's why you see OPEC trying to reduce the supply as a way of adjusting for falling demand. Of course, at some point, the market adjusts for a recession. But I would say that most people think that the US is going into a soft landing. I think the US is going into a hard landing. And therefore, I think oil price will come down further. And I don't think that it's going to be it's not going to push the inflation up. Frank, good to see you. Does the seasonal impact energy, less heating in summer months? Yes, but remember, Frank, it's a year-on-year growth comparison. So I am comparing the current number against the last period, same period. So in a year-on-year graph, the seasonal impact shouldn't be an issue. So Oluwafe Ka, good to see you. Feel free to ask any questions. I'm going to continue on. I've got a couple of other charts to show. So this particular chart is the real key to why inflation is coming down. And that is 79% of US CPI is driven by what's called commodities and services. But really what it is services. And what are the main services? Well, one service is healthcare, of course, but a big service is owner's equivalent rent. And this is slowly adjusting as house prices or home prices rise. What's happening? Home prices rise very quickly and then they fall very quickly. But the owner's equivalent rent is just a made up calculation where they're surveying owners and asking them what the rent would be right now if they had to rent the place that they have. And so what happens is that the rise and the spike that we see in the house prices, which I don't show on this just because I didn't want to confuse it, that the rise in the house prices was what pulled that blue line up. And what's pulling it down is the fall in housing prices. So housing prices have already fallen considerably in the US, and I suspect they're probably going to fall further. And the result of that is that this owner's equivalent rent is just a steady down cycle. So about 6 months ago, I was talking to my clients here in Thailand and telling them that CPI is going to fall. And one of the main reasons is because of this owner's equivalent rent. It's just slow to price in. Hi, Brett. Let's see. Brett says, higher prices from the past few years are now baked in, and whilst rate is coming down, there are little signs that we see prices back to where they were. Yeah, I think that basically what's happening right now is that the year-on-year comparisons are starting to get more realistic. We're not comparing against extreme highs, and that will eventually cause CPI probably to stabilize at maybe 2% or the like. But I would say that there's really, what you're saying is there's little signs that we see prices back to where they were. I agree. I don't think we're going to see a big push on prices. And the reason why is because I'm expecting a pretty severe recession. If we get a severe recession, what's going to happen is that prices are going to fall because demand is falling. Now, in addition, if we get a recession, the other thing that'll happen is the Fed will drop interest rates back to zero. And if the Fed drops interest rates back to zero, then we are in another situation. So let's just look at what I'm expecting from the US economy. I'm expecting recession, that it comes in the next, let's say, 3 to 6 months, and it comes hard and fast, and the market falls and the economy starts to fall. And the Fed will do the same thing it's always done, is cut rates back to zero. This is particularly important now that the US has more than $30 trillion of debt, because during a recession, corporate tax receipts, individual tax receipts fall, and therefore the budget budget deficit really rises. And so what they want to do is bring down interest rates so that the rate that's being paid on government debt is a rate that is very low, so that the government and politicians can continue to spend. Now, after we go into this recessionary period and the Fed reduces interest rates, what I'm expecting next is that eventually that will drive the next phase of inflation, because ultimately the Fed will start pumping money into the system. And in addition, though the market could fall substantially, let's say going into a recession, the reality is that I believe the Fed already has demonstrated that it would enter the market. It entered the bond market in 2020 buying bonds, corporate bonds. It did it through a very interesting sleight of hand by having the US Treasury Department set up a special purpose vehicle, having the Fed put money into that vehicle, and then having that vehicle assign BlackRock to go out and buy corporate bond index funds of bonds at that time. Just the action of doing that, of course, caused the bond market to recover, and they didn't need to invest that much. But now that they've got a pathway to do it, I think that they can do it in the next recession for stocks. All right. let's say, Brett, I entirely agree. Buckle up. Yeah, there is some real risk. And I think for those people that are running businesses, that own businesses, as I do, we have to be very careful right now. In other words, build up cash, protect your margin. Brett says, do you think the relevancy of the US dollar would dilute the effectiveness of the Fed in the next 5 years or 10 years? Yeah, I think it's going to be a while before the US government loses control of the US dollar. And the reason why is because the US has weapons. The US spends almost $1 trillion on war. And the power of war is the big, big thing that the US can force on others. Also, I highlighted about a year ago for my clients in Bangkok that we were entering World War 2.5. In fact, World War 2.5 already happened and it's over. And America won. And who were they fighting? They were fighting Europe. Now America is in complete control of Europe. And therefore, they can use that control because remember, the key about Europe is that it's the developed economies, the developed banks. It's the second biggest part of the global order of the US. And therefore, they can control the flow of dollars through European and US banks and punish and reward countries based upon their behavior. And I think they're going to use that and also the force of the military. A great example of that is the Iran deal. When Trump left the Iran deal that Obama had signed, Europe wanted to continue trading with Iran, but the US stopped it because they used their control of the banking system. Now, also, Brett, you said, funny how the Fed that caused inflation is likely a deep recession. They're the ones to the rescue, of course. Remember, for the young people out there, remember, government is never the solution. They always end up causing more problems. And I don't have to say that, it's totally understood by anybody in politics in Thailand. How about in Nigeria? But for some reason, people forget about that. All right, let's continue on. If you have any questions or comments, feel free to put them in. I have a couple of other charts and then I'll wrap up for today. So the next chart is my forecast, basically. So what I've done is, been looking at my forecasting of CPI. Originally, I was saying about 3% by the end of this year. Now I've lowered that down to 2.3. And basically, we're going to be below the long-term average for US CPI. Now, that's an average from 2006 to 2023. You could take it back further or nearer and have a different average. But for that period, 2.5, we're going to be below that average. And I think by that time, we could even start to see CPI kind of collapsing if the economy is falling. And here we can see, in fact, in this chart, if you look at 2007, it was at a peak, and then 2008, it came down to -2. And that was through 2009, actually, that happened. So it's very possible that our CPI could go negative when we actually go into deflation rather than just disinflation. So that's my forecast for inflation by the end of this year. And that is going to be US CPI is going to be 2.3%. Now, the one caveat is that if oil bounces back, that is not going to happen. CPI is going to rise. Oil is a determining factor of CPI. Let's see. What else? Yep. Okay. So let's continue on. I've got a couple of others. Again, if you have a comment or a question, feel free. I thought it would be good to look at the US dollar to think about what's happening. So basically, what I've done here is shown the ups and downs of the US dollar index and try to understand, what's happening there. And what we can see is there's been a significant fall in the dollar. And that fall in the dollar, it could continue. The thing about that is that when the dollar is weakening, it is driving inflation more in the economy. So if the dollar strengthens, it means less imported inflation. And I think that if we go into an if we go into a recession, you see that oftentimes the dollar becomes much higher because of its safe haven status. And this is an important thing to think about. I'm going to come back to that in just a second, but I've made another chart for this morning's presentation. And that is just looking at the US dollar index, the blue line, just to understand kind of where it is. It's good to look at the percent change, which we were looking at on the prior chart, and what you can see here also. But what you can see is that the dollar is above its long-term average of 94. So the dollar, even though it's come down a bit, it's stabilized, but it's stabilizing in a strong position. So we've got a pretty strong dollar right now. So I'm going to wrap up with some final thoughts about this. And the first thing is, I think a strong recession is coming in the US. It's been very long time since we've had a real recession, since 2008, basically. And I think that the Fed's going to reduce interest rates dramatically, close to zero again, to try to deal with it. It could cause the stock market to crash. And of course, it's going to cause the economy to come down. And then I think that the Fed is going to come in and start printing money, and we're back to QE. And what will happen is they'll lower rates, and they'll do that through buying bonds off of the banks. And what we'll see is that there'll be a recovery and also a potential that the Fed is going to start buying stocks in the US stock market. Now, the Fed's not allowed to do that, but they've got a sneaky way of doing that through a cooperation with the Treasury Department, which they've already shown to do when the 2020 crisis happened and they tried to save the bond market. So the answer to the question that we started off right at the beginning, just to go back to that, is the question is, will US inflation continue its slide? And my answer is yes, it will. Thanks, everybody, for listening. Brett and all the others, for your comments and questions and suggestions. Feel free to let me know if you want me to look into other topics. I love to do that. Have a great day.